Did Wall Street just pull off the most coordinated Bitcoin shakeout in history? Last episode, we walked through the strange timeline behind the crash, the MSCI memo that resurfaced at the perfect moment by JP Morgan and their MSTR delisting FUD. Well, just yesterday, JP Morgan unveiled a new product that suddenly makes the entire picture snap into focus. Today, we're going to lay out why it's becoming clear that this crash was no accident, and why the real pivot point for Bitcoin has nothing to do with the 4-year cycle and everything to do with the business cycle that's only just resetting. Stick around, because what this shakeout sets up next could be the liquidity surge that defines the rest of the decade. Welcome to No Second Best, the show where conviction meets reality and reality points straight to Bitcoin. I'm Hurley. Happy Thanksgiving to those watching in the US, and now let's get into it. Bitcoin has started off the holidays with a little rally off the 80K lows from last week, now hovering around 91K. And there were several pieces of news that hit this week that contributed, which we'll get into a bit later. But first, we all know this wasn't just another ugly correction. This one did feel targeted, and the announcement JP Morgan just made yesterday all but confirms it. In the last episode, we laid out the JP Morgan FUD in more detail, so I highly suggest you go watch the full video from yesterday if you haven't already. But let's do a full recap of the full timeline of events that led to the crash. You had Jim Chanos coming out with the long spot Bitcoin and short MSTR trade in the summer, along with JP Morgan quietly hiking margin requirements on MSTR loans from 50% to 95%. You had the MSCI consultation memo floating the idea that companies with too much Bitcoin on their balance sheet might face index removal. And then right when Bitcoin sentiment was nearing rock bottom, JP Morgan suddenly started warning clients about the MSTR delisting risk and blasting that memo back into the news cycle. For all intents and purposes, this did look like a hit job on Michael Saylor's playbook. Whether it was fully coordinated or just opportunistic, the effect was the same. Push people out of the leading Bitcoin treasury company while fear was at a maximum. Now fast forward to this week. The same bank that was fanning the flames around MSTR and Bitcoin treasury risk has just rolled out a leveraged product built on BlackRock's Bitcoin ETF, IBIT. In other words, we're not saying don't use Bitcoin for leverage, we're saying don't use their Bitcoin for leverage. Use ours. And we're supposed to believe this is all just random. Sure, chalk up some of these timelines to coincidence. Internal risk models are real, regulators are real, but incentives are real too. And the pattern here is hard to ignore. Saylor opened the door to the $300 trillion bond market with a Bitcoin-backed strategy, and the biggest banks on earth are now trying to walk through that same door after doing their best attempt at nudging him out of the way. They're not protecting you from risk, they're trying to control where the Bitcoin leverage flows in their direction. Take a look at this. The number of wallets holding 0.1 or more Bitcoin went down during the dip, while wallets with 1,000 plus Bitcoin went up. This paints the picture of the shakeout. Newcomers exiting and big money accumulating. And this is exactly why most people don't make it. And I don't think it's a coincidence that this whole shakeout happened at the perfect opportune time when the 4-year cycle would normally be ending. So that's the political layer, the shakeout. But under the surface, there's a monetary story playing out that's much bigger than JP Morgan. To set this up, let's go to this clip of Bitcoin on-chain analyst checkmate on what Bitcoin did.
So gold doesn't move until it wants to move. And when it moves, you should pay attention. And it's clearly moved. The most overheated it's been since 1979 in terms of distance from the 200-week moving average, no matter how you want to cut it. It's telling us that the system is bankrupt and we have to move to a new reserve asset. Like that is a very important signal. In my world, gold tells me where we're going. Bitcoin is much more sensitive to the near term. Yeah. And the near term, the rate of change of liquidity hasn't been great. It may actually be hairy moving forward. You get any weakness in equity market, that falls off. Suddenly collateral goes down, bond volatility goes up, and everything gets squeezed. That doesn't mean that the follow-up is not going to be tremendously on the side. So I do believe there is a convergence between Bitcoin and gold that shows up, but I think Bitcoin goes the road to get there. And it's been telling you that the equity market probably is due for a pullback as well. Front runs that liquidity profile. So my base case is that Bitcoin will probably lead us back out of this thing when all the equity guys are going, shit, call Jay Powell, it's all over. And Bitcoin's going to start bottoming out and moving and say, here it comes.
So on one side, we have gold ripping in 2025, screaming stress and the need for a monetary escape valve. And on the other, we have Bitcoin getting clubbed down 35% from all-time highs. Not because the long-term story broke. Partially this can be attributed to the shakeout, but also largely because the rate of change of liquidity turned against it for a moment. And this is where guys like Tech Dev add another layer to the story. He's been sharing a chart with 2 simple lines on it. The top line is where the liquidity fuel has historically been exhausted. You can think of that as when the business cycle turns over. That's where multi-year tops form. The bottom line is where that fuel has historically ignited. That's where the multi-year parabolic moves begin. His point is simple. Bitcoin doesn't care about the calendar. It cares about liquidity. And if you look at where we are on this chart, we're nowhere near the exhaustion zone. We're just entering the ignition zone. And that matches the vibe of this whole cycle. Many people think this cycle topped at 126K. But what if we're barely halfway? With the parabolic phase still ahead. This cycle's glacial pace is shaking people out, not with volatility, but with time. And time can be just as brutal as a 40% dump. And if this dip really is being driven by a temporary liquidity contraction before a stimulus wave, the only clean historical comparison we have is the 2020 COVID crash, the ocean pulling back before the tidal wave. Now, you could write that off as just Bitcoiners talking to Bitcoiners. But what happens when the biggest asset manager on earth is saying something very similar? And that's where Robbie Mitchnick comes in. He runs digital assets over at a little old institution called BlackRock. Listen to how Robbie describes what actually drives Bitcoin.
There's a couple of macro variables where actually it does make some fundamental sense to see a little bit of correlation. And it's all sort of in the family of, you can call it liquidity. I prefer to call it real interest rates, US dollar, real interest rates, US dollar strength or weakness. All those things which kind of move together, or inversely, right? Liquidity up, US dollar down, real interest rates down, and vice versa if liquidity is in the other direction. That definitely impacts Bitcoin just as it does gold, just as it does emerging market currencies, and just as it does most of the assets in the portfolio. So today, for example, that is what's driving the market, basically, is there's been a re-rating of how likely we are to get a rate cut at the next Fed meeting. That's something you would actually expect Bitcoin to be affected by, like the rest of the market. But that's just this type of risk factor, right? When something completely different happens, let's say a geopolitical flare-up somewhere in the world, that's a totally different story. That's probably a catalyst for Bitcoin, right? Because again, Bitcoin exists outside of any one country's economic, political, etc. risk factors. But people get confused and they start to just program that risk-on narrative into everything.
That's the largest asset manager on the planet saying that Bitcoin is not being driven by the halving calendar. It's being driven by the same forces that move gold and FX, real rates, dollar liquidity, and global risk. And here's the kicker. We're heading into a period where those forces almost have to turn in Bitcoin's favor. We just watched the market reprice the odds of rate cuts in real time. QT is ending. Fiscal discipline is dead. And this week, Trump's favorite candidate for the next Fed chair leaked. And it's Kevin Hassett, a growth-obsessed, deficit-tolerant, politically loyal economist with prior ties to, wait for it, Coinbase. You don't have to love Trump to recognize what that combination means. Lower real rates over time, more political pressure on the Fed, and more demand for assets that exist outside that political money game. Gold understands it, Bitcoin feels it, and Wall Street is quietly positioning for it. Now let's talk about what actually happened during this crash under the hood, because the on-chain data doesn't tell the story of a market that's topped. It tells the story of the massive rotation we've been talking about on this show for months. Here's where Checkmate drops the bomb that I think every Bitcoiner needs to internalize.
I mean, to be fair, this rotation, like the majority of this selling has occurred really within the last 6 months. So that was, and a lot of it was above 120K. If we look at, we use metrics like realized profit, which shows the delta between when a coin was acquired and when it was disposed of. We saw, again, billions of dollars a day in realized profit. And this is the other thing you can see: coin day destruction, lots of old coins coming back to life, revived supply, the volume of them, how much profit they're locking in. All of these things were like record highs in the March pump in 2024, in November, December, January, when the kind of called the Trump pump. And then this has been a very sustained period of the back half of 2025, just tons and tons of sell side and ramping up. But what we're now seeing is the folks who are selling, there's a lot of people who are like 6 months to a year. Those guys are people who wish they had bought NVIDIA. They gave up the opportunity cost. They held Bitcoin. The momentum went nowhere. A lot of those guys are now selling and taking a loss, crystallizing a loss. And this is probably, if there's one thing I can just help people understand right now, 70% of all of the wealth that's ever been invested in Bitcoin, if we price every UTXO based on when it last moved, 70% has a cost basis above 85K.
That's insane.
70%. This is Bitcoin's new home. So, if you're talking about 30K and 10K and 5K Bitcoin, the truth is it's like ancient history. It just doesn't matter. There's not enough wealth down there. The wealth is all up here. Now, because we're below it, that's a lot of potential sellers on the way back up. So the bulls have got a lot of work to do to get us out of this mess. However, the rotation of this capital, think about who these new buyers are, right? These aren't retail hodlers putting in their pocket money. No one's got these kind of deep pockets. We're talking, there has to be, could be banks, could be sovereigns, could be a bit of everything. I saw the other day, I forget which Gulf state, but there's a Gulf state that bought like $500 million worth of the ETF. So like sovereigns are interested in this kind of thing. And these folks feel like price insensitive buyers.
Yeah.
Where they just accumulate, and they're just forever allocators. So there is going to be this rotation. Markets have got to go through this process. It'll take time to hammer out this bottom. But at the same time, these guys probably aren't, they're sailor types. They're not going to sell.
This means the center of gravity for Bitcoin has shifted. The $10,000 Bitcoin era, even the $30,000 era, are now ancient history in terms of where the serious money is now parked. And if 70% of the capital stack is above $85,000, you have to ask the obvious question Checkmate does. Who on earth is buying all of this on the other side? Who has the balance sheet to absorb multi-billion-dollar realized profits, months of heavy distribution, and a full-on panic flush down to $80,000? It's not retail, it's not plebs, it's banks, it's sovereigns, it's massive funds. It's the Texas Bitcoin Reserve dipping a toe with $10 million in IBIT. It's Gulf states quietly buying $500 million worth of ETFs. These are forever allocators. They don't care if their cost basis is 85 or 95K, because they're thinking in decades and in currency regimes, not in 30-day candles. And right alongside them, NASDAQ just reclassified BlackRock's IBIT into the same tier as mega caps like Apple, Nvidia, Microsoft, SPY, and QQQ, and expanded options limits by 40 times, from 25,000 contracts to 1 million. Translation, Bitcoin is a top-tier global asset now. So let's put the pieces together. Gold screaming systemic stress, Bitcoin flushed by a shakeout and temporary liquidity contraction, JP Morgan and Morgan Stanley positioning to sell Bitcoin-backed notes while undermining MSTR, 70% of all Bitcoin wealth sitting above $85,000 price range, and sovereign states and asset managers quietly soaking up the other side of the trade. Does that look like the end of a bull market? Or the messy, confusing middle, the part where coins move from fast hands to slow hands, from weak conviction to strong conviction, with a lot of people getting shaken out along the way? Now, before we zoom out one more layer, I want to bring Robbie Mitchnick back in one more time, because he frames Bitcoin's role in this environment in a way I think is really telling.
There's only two assets that have emerged, maybe three if we count silver, in the last multiple thousands of years that became globally adopted as a monetary alternative. Gold, you could say silver at some point, less so today, and Bitcoin. So that's an incredible achievement for Bitcoin. Obviously, Bitcoin is newer than gold. It's more volatile than gold. It's risky as a kind of novel technology instrument, but it also has a lot in its favor as something that is digitally native in an increasingly digital world that is efficient to store and can be moved anywhere in the world in near real time and near zero cost. So Bitcoin has registered in the arena as a real competitor, a real option in that space of things, of a small space of things that you can use to kind of play this debasement trade. And we've seen that resonate.
Again, that's BlackRock's head of digital assets saying Bitcoin is now in the same conversation as gold as a global monetary asset. So when you see a crash like the one we've just lived through, you have to choose how you interpret it. Is this the end of Bitcoin's story? Or is this exactly what you'd expect to see when a young monetary asset tied tightly to global liquidity gets stress tested on the path to becoming the alternative reserve of a bankrupt system? And all of this is why I keep coming back to one simple point. You cannot trade your way through a monetary revolution. If your Bitcoin strategy depends on perfectly timing entries and exits around a 4-year halving chart, you're going to get run over by people who are quietly buying every single panic headline, because they're not thinking about this week's candle. They're thinking about the next decade of debasement. That's also why how you hold your Bitcoin matters. If your only exposure to this asset is through banks that can freeze transfers, or through brokers who only see you as a distribution channel for their latest structured note, you're playing this whole thing on hard mode. The whole point of this asset is to ultimately get out of the game where someone else can inflate away or pull the plug on your money. And that's what Swan Private was built for. The Swan Private team works with individuals, families, and businesses who understand that this isn't about gambling on the next 10% move. It's about building a serious Bitcoin position over time, moving it into robust and secure self-custody, and building for a generational inheritance plan. If you want to partner with a team that actually lives and breathes this stuff and is building for that same long-term horizon you are, head to swan.com/no-second-best and talk with a member of the Swan Private team today. So where does all this leave us? We have gold at historic extremes, telling us the old system is cracking. We have Bitcoin recovering from a brutal, coordinated-looking flush, with serious buyers increasing their position in size. We have BlackRock and NASDAQ elevating Bitcoin to mega-cap status. JP Morgan and Morgan Stanley building leveraged products on top of it. Texas and Gulf states dipping into reserves. And a potential Fed chair who all but guarantees the next era will be more political, more inflationary, and more fragile than the last. Does that sound like the aftermath of a popped bubble? Or the setup before the liquidity wave that reprices everything? For me, the answer is pretty clear. But it's important to remember that we're not here for the hype cycles. We're here for the monetary revolution. So what do you think? Was this crash mostly just normal leveraged wipeout and sentiment panic? Or do you see a coordinated shakeout? Are you ready to admit that the 4-year cycle is dead and liquidity and the business cycle is in the driver's seat now? Drop your thoughts in the comments, and if you got value from this video, hit the like button, share it with someone who isn't paying attention, and don't forget to subscribe to the channel if you haven't already, so you don't miss the next one. Thanks for watching, and remember, there is no second best money.